We go ahead and call to order the Friday, August 7th, 2020 Retirement System Board of Trustees meeting, called to order at 8:09 a.m. Number one is public comment, which I've been told that there is none. Two is request that the board approve the agenda for August 7th, 2020. I'm going to go ahead and make that motion. Is there a second? I have a second by Paul Brake. All in favor?
Aye.
Aye.
I forgot. We got to do this. Okay.
Record, you should do a roll call after you call to order, so everything's in.
Okay, sounds good. So let's go ahead and finish this motion that we were on. So I'm in favor. Kyle?
Yes.
Paul?
Yes.
Brad?
Yes.
Motion passes. Quick roll call with us today. We have myself, Lee Colick, the chair. We have Brett Nelson, the vice chair. Kyle DeBuck as a trustee. Ken Gibbs is absent. Paul Brake as a trustee. Julie Rudd is the chief administrative officer, board secretary, board treasurer. Lisa Genord as the administrative assistant, pension technician. Tom Michow as the board attorney, and Terry Gerlich with the investment advisor with SEI. I think I got everybody because Brian's not needed at this meeting. That said, we will go ahead and I'm going to make a motion requesting that the board approve the minutes for July 10th, 2020. Is there a second?
Brett.
Second by Kyle. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
Motion passes. Requested the board consider adjustments applications for benefits as follows. Constance M. Joswick, formerly of the Police Department, ROPOA bargaining unit, 17 years and 3 months of service credit, requested the deferred retirement date of May 31, 2020. Selected option D, 75% to surviving spouse, 3134.77 gross monthly benefit with withdrawal of contributions and interest of 52,101.66. I'm going to make a motion to approve that. Is there a second? Second by Paul. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
Passes. Brings us to investments. I'm going to turn it over to Terry.
Well, good morning, everybody. I'm just going to share my screen here in a second. Can everybody see that?
Yes.
Great. Okay. Well, literally hot off the presses, we just finished the performance calculations as of yesterday. And as you can see, July was another good month. And so putting together a string of several months now to restore the value after the market panic in the first quarter. So as you can see, for the month began at the end of the second quarter at $150,375,000. Net cash flows out of $738,000, but a further gain of $6,433,000, leaving, as you see, the portfolio value of $156,069,775. Importantly, if you look all the way over to the right, you can see the trailing 1 year and combination of about a little over $9.5 million out in cash flows to pay benefits primarily, but a gain of just under $11 million. So the balance, even after the cash flow out, is now restored, if you will, and back up above where we were a year ago. Still a little ground to make up in terms of where we were in December. You see that in the column on the year-to-date column, but continue to post some progress there in that endeavor as well. See if I can move this along here. Here we go. So for the month, as I say, it was a good month. On a gross basis, the portfolio was up 4.32%, or 4.3% net, leaving, or I should say not leaving, but a little bit ahead of the benchmark, which was up about 4% for the month. So the last 3 months in particular, you can see the progress. So the trailing 3 months up, net up about a little over 12% versus 10.2% for the portfolio combined benchmark. And year to date, you now see that we're a little positive there, which is good to see. Up 1.78%, pretty much right on the benchmark, which was up 1.77%. So had been behind a little bit during the panic in the first quarter, and now have made up that relative performance. So both absolute and relative performance moving in the right direction. And it really has been just a continuation of what we saw and what we discussed the last month, that investors, after the big sell-off due to the COVID pandemic in the first quarter, investors began to look out a year and started looking to 2021 and started to gain some confidence that as bad as things are in the near term, the markets and the economy in particular will do better in 2021. So they're kind of treating it like a natural disaster, where often when that happens, whether it's a hurricane, what have you, got a local economy that's hit pretty hard, but then bounces back. And that's really the way the market's treating this. In a normal recession, once you start losing a growth, it tends to spiral down because there's a lot of deleveraging going on. So you see default rates go up for companies. You see consumers, as people become unemployed, they start defaulting at a higher rate on their credit cards, their auto loans, their mortgages, and then credit tightens as a result of that. And that tightening of credit then causes things to slow down even more. So it tends to spiral down in a normal recession. Right now, because of what the Federal Reserve has done in terms of monetary policy, they've eased credit conditions significantly in the financial markets, have made the flow of credit continue. They've been out aggressively, not only injecting liquidity into the marketplace, but also directly easing credit, any credit constraints by buying credit instruments. And similarly, it is very important, the fiscal stimulus through the CARES Act, trillions of dollars here, and now further discussion about extending benefits, has helped consumers even with a dramatic fall in GDP. And we're talking well over 30% decline in GDP. And yet personal income actually went up in the second quarter significantly because of the CARES payments, the supplemental unemployment payments of $600 a week, have really helped people to continue to pay their rent, pay their mortgages, and their other bills. So right now, because of that intervention, the markets continues to look forward, and that obviously begs the question as to well, is the market right or not? And it really depends on COVID. The market is saying right now is the expectation is there'll hopefully be a vaccine by next year, or at least even more or much better treatment. But that remains to be seen, obviously. So there still could be a period of significant volatility here. Right now, we're riding that volatility to the positive side the last 3 or 4 months now, and continuing into August up another almost 3% on the markets. But we could very well turn on a dime here if sentiment changes as to the future prospects. But right now, headed in the right direction. So as you can see, as we look down over the various strategies, you can see equities led the way again in the month, up 5.7%. and we're led by U.S. equities, as you can see, large cap of about 5.6, 5.7%, and the small to mid cap actually up a little bit more, rebounding, after having sold off pretty hard earlier in the year, rebounding at about 5.9%. So you can see the trailing 3-month numbers there, but that on a year-to-date basis really kind of getting us back to sort of flattish after all the destruction in the first quarter. Fixed income, good performance there in the month. Core fixed income up 1.9% versus 1.5% for the benchmark. I guess I skipped right over world equity. I apologize for that. So let me back up for a moment. Your non-U.S. equity portfolio, as you know, is actively managed. Interestingly enough, the overall the performance in non-U.S. was just the same as U.S. equities, both up 5.7%. But importantly, the managers have been doing a good job in the last few months, and that continued in the month of July. As you can see, the developed markets and some emerging exposure in that up 5.2%, and then the dedicated emerging market exposure up 8.8%, and in the former comfortably the head of the index, and the emerging markets pretty close to the benchmark there, and the last 3-month performance has been good. So no concerns there. We're happy with the way the managers are performing. So now fixed income up 2.6%. In core fixed income, which is really our more defensive area of the portfolio, continues to do its job even in the rebound here as interest rates stay low. So up, as I say, 1.9%, comfortably ahead of the benchmark. And it's extraordinary when you look at it on a year-to-date basis, up almost 9% versus 7.7%. The reason it's extraordinary is that we, as you know, we entered the year with very, very low interest rates, and it wasn't normal circumstances. There wouldn't be a lot of room for further appreciation as rates were already so low. But rates continued to drop pretty significantly here in 2020, and now we're looking at a 10-year Treasury at around 0.5% interest, and the 30-year Treasury at about 1.2% yield. So very, very low rates. But at least in the short term, that decline in rates has meant continued appreciation in the bond portfolio. The credit sectors have rebounded now, or are rebounding. There's still more to go, but rebounding as well after getting hit really hard earlier in the year. And you can see emerging market debt up 3.7% versus the benchmark of about 3.4%, and high yield 4.6% versus 4.75% for the benchmark. So somewhat in line there. Core property posted performance, and remember, this gets posted once a quarter. It's quarterly number for this area. So the number you see in July is really the performance for the second quarter, and down a little bit, not surprisingly, down a little bit, about 1.5%. But for the year, up slightly at 1.1%. So holding its own there. It's been much more stable than the volatility we've seen certainly in the equity market. So it continues to provide important diversification for the portfolio. And then finally, structured credit. You can see the significant rebounds there, as we talked about earlier. Those securities being illiquid tend to see the prices move around dramatically, much more than even the fundamentals would suggest. And we thought it was, well, the timing was terrible in terms of when we started, given the panic in the first quarter, rebounding strongly here now, and we see that continuing here over the last several weeks. So up about 3.5%, and up over 20% over the trailing 12 months. Still, as you can see, significant ground to make up, but heading very strongly in the right direction. And then private equity, again, money is just starting to get drawn down by the underlying private equity managers and funds. So we've got $75,000 invested so far. So not really a meaningful number yet in that category. But as you can see, posting 86 basis points for the month. So overall, it's good to see the market, the portfolio continue to recoup from what happened earlier in the year. And July is really a continuation of what we saw in the second quarter and what we discussed at the last meeting. As I say, though, cautionary note, things could turn around on a dime here, but we're hopeful that the market's correct and looking forward, and that there will be a vaccine, there will be some relief from the pandemic going into 2021. So with that, I'd be happy to answer any questions people may have.
Does anyone have any questions for Terry? All right, well, thank you, Terry. I appreciate it.
Well, thank you very much. Everybody, I hope, continues to stay safe. And I'll pass it back to you, Mr. Chairman. Thank you.
All right, thank you. I'm going to go ahead and make a motion to receive and file the information that Terry provided. Is there a second? Second by Brett. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
Motion passes. Terry, you could hang on for a few here, and then we'll
Will do. Yep.
yeah, we're going to continue then to legal. I'm going to turn it over to Tom.
Thank you very much, Mr. Chairman. The first few reports, Robbins Geller, are simply for your information. Would recommend that you receive and file at this point.
Okay, I'm going to go ahead and make that motion to receive and file. Is there a second? Second by Brett. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
The motion passes.
The next reports, we continue to keep you up to date regarding the state as well as federal regulations. This is somewhat of a continuation of prior reports and memos that we've provided. Open Meetings Act, Freedom of Information Act, other things at the federal level with the CARES Act. It seems that we're kind of continue to be status quo, which isn't necessarily a good thing, but we'll continue to keep you up to date as changes occur at both the state and federal levels. If anyone has any questions, I'd be happy to address them. Otherwise, these are just for your information as well, and would recommend receive and file.
Sounds good. Does anyone have any questions about those? I'm going to go ahead and make the same motion then to receive and file. Is there a second? Second by Brett. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
The motion passes.
And that concludes my legal report, Mr. Chairman.
All right, thank you, Tom. It brings us to other. Julie, did you have anything under other?
No, thank you.
Okay. Let's go ahead and set the date for the next meeting, which looks like was going to be on Labor Day Monday. So tentative date would have been Monday, September 7th. Feelings on Wednesday, September 9th. Does Wednesday, September 9th not work for anyone at 8 a.m.?
It's fine by me. Does that give enough time for a consultant to prepare reports?
It'll be very close. Hopefully we'll have it by the 8th. I'm just a little concerned with the holiday in there in between. It only gives us really a couple days, a few days before that. We should be able to, I can't guarantee it.
When could you guarantee them?
I think the 10th, just to be
Or even
safe.
if you want to make it Friday, September 11th.
Okay. Does Friday, September 11th, 8 a.m. in the morning not work for anyone?
I have to take my husband to a procedure that morning. I'm not sure when it exactly will be, so I might not be available necessarily
Okay. How about Thursday?
Friday.
Okay. Let's go ahead and set that date then. Terry, we'll just do the best.
Okay.
We can. Hope for the best from Terry and Brian then. But
Okay,
we'll set it
that should work. That should work.
Okay.
Thank you very much.
Absolutely. Thursday, September 10th, 8 a.m. I'm going to go ahead and make a motion to adjourn. Is there a second? Second by Paul. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
Meeting adjourned at 8:31 a.m.
Thank you all.
All right. Thank you, Terry.
Talk to you next month. Bye-bye.
Sounds good. Does anyone need a break before we jump into the next meeting? All right. I will call to order the Friday, August 7th, 2020 Retiree Healthcare Investment Board meeting. Called to order at 8:31 a.m. We'll do a quick roll call here. We have myself, Lee Colick, chairperson. We have Brett Nelson, vice chair. Kyle DeBuck, trustee. Kim Gibbs is absent. Paul Brake, trustee. Julie Rudd, board chief administrative officer, board secretary, board treasurer. Lisa Genord, administrative assistant, pension technician. Tom Michow, board attorney. Brian Green, investment advisor. One is public comment. I've been told that there is none. Two is a request that the board approve the agenda for August 7th, 2020. I'm going to go ahead and make that motion. Is there a second? Got a second by Paul. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
Motion passes. Three is request that the board approve the minutes for July 10th, 2020. I'm going to make a motion to approve those minutes. Is there a second? Got a second by Brett. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
Motion passes. Brings us to investments. I'm going to turn it over to Brian Green.
Perfect. Carol, can I do screen share? I can bring up my report. Maybe not. Okay. I can make this pretty easy. So we've talked in previous meetings. I remember last year when Boeing was going through all of their issues that they kind of continue to struggle with a bit, but with a number of the 737 Maxes crashing. I remember talking about how the Dow was going to be up or down, based on news because of the way that index was constructed. So we spent some time in the past talking about kind of digging into numbers a little bit and having better context around this number's hitting the headline, but when you dig into the number and understand it a little bit more, it maybe will change your opinion. So there's a lot of talk around second quarter GDP, second quarter economic growth falling by like 30 to 33%. And that's a big number. But what's funny is when you dig into that number a little bit further and start to have some context around actually how that 33% decline is calculated, the reaction is much less of a, oh my, we have a major problem here, and more of a general state of confusion, as well as I really don't know why they would calculate it like that. So when you look, excuse me, at actual numbers for Q2, so what they do when they make a comparison is we look at Q2 of 19 versus Q2 of 2020.
Hey, Brian, can
And
Brian?
yeah,
You're a co-host, so you can screen share. If you
okay, it just turned on.
Okay.
So Q1 of 19, the economy grew. Economic activity was about $4.7 trillion. Q2 of 2020, economic activity was $4.3 trillion. So that's a almost $500 billion decrease. That's not a 33% decline. Where this actually comes in, and if you're confused at the end of this presentation, at the end of this discussion, you'll be in the exact same situation that I am, because I've spent a good part of yesterday reading about this. But how that 33% figure is calculated is they look at the change from Q1 to Q2, and that was a 7% decline, and then say, okay, every quarter for the next 3 quarters, we're going to assume that that quarter's economic activity declined by that amount. So when you figure in 7% of this quarter, 7% next quarter, 7% the following quarter, 7% the quarter after that, that's how you get to a 33% decline in economic activity. So why they calculate it like that, I have no idea. In reality, when we look at a lot of projections we see for economic growth for the year, it's a decline of like 4 to 6%. So that tells you if we expect a decline for the entire calendar year for the economy of 4 to 6%, and we declined by 7% here in the second quarter, that we should actually have some growth for the rest of the year. So I wanted to take a minute and just kind of talk through that. And again, it is one of the most confusing. I kind of think I'm going back to like high school and early college days of like Calculus 2 and Calculus 3. And when I made the realization early in college that there was absolutely no way I was going to be an engineer, because I understood more of, French 2 than I did of Calculus 3 in terms of a foreign language. So that 33% number is a big headline, and it is something you should be aware of. But when you actually figure out how they calculate it, there is an assumption that there's a whole lot of bad news every quarter for the next 3 quarters for that 33% decline figure to actually be accurate. So that's what the economic statistics are telling you. The market is telling you something drastically different. So we saw a continued rally in July. Stocks, for example, the S&P up 5.6%, and large cap U.S. stocks are actually now in positive territory for the year, led by tech stocks and consumer discretionary. So what I find is kind of funny as you dig into the numbers a little bit more, if you look on a year-to-date basis, S&P now up 2.4%, but really every other part of the equity market is still in negative territory. Mid-cap stocks are still down almost 4%. Small cap stocks are down more than 10. International stocks, when you're talking about developed markets, are down 9, almost 10%, and emerging markets are down about 1.7. So outside of the S&P 500, every other part of the equity markets, U.S. and international, are in negative territory. And from a style standpoint, if you had any growth bias, which means you had more technology and consumer discretionary stocks, you did well. You can see this, for example, from a style box standpoint. Large cap growth stocks so far this year up a whopping 18%. I thought we were in a global pandemic, and we just talked about a 33% decline in economic growth. Yet large cap growth stocks are up 18%. Small cap growth stocks are flat for the year so far. Value stocks still down double digits, so you have not seen the recovery. And here's really the basis for that, and what's become kind of an interesting conversation. If you look at things on a year-to-date sector return standpoint, so this breaks apart the S&P 500, right? So 500 stocks, 12, 13 different sectors. So the S&P as a whole for the year up 2.38%, but you've got better than a 50% difference in returns between the best performing sector and worst performing sector. Worst so far this year, no surprise, energy stocks down 38%, best performing information technology stocks up 21.4%. The big surprise this year has been in the midst of this, pandemic, recession, economic decline, no one is surprised that technology stocks have rallied, right? Look at what we're using right now, just a massive amount of technology that we've had to roll out for virtual learning, for work from home, for any number of things to stay connected with family and friends. So that tech stocks have rallied so much isn't necessarily a surprise, but consumer discretionary is. And when you dig into that sector a little bit more, there's one name that won't come as a surprise. Amazon is actually rated as a consumer discretionary company. Wayfair, the online discount retailer, Etsy, right? Kind of the online, I'm going to call it an online, kind of home craft website, right? If you're a small producer of goods, this is an excellent marketplace for you to sell into. Like Etsy stock has just crushed it so far this year. And then another name that I think would actually come as a surprise given how hard that industry is hit, but this is probably near and dear to Tom's heart, considering he's probably in his Winnebago, but one of the best performing consumer discretionary stocks is Thor Industries, which is an RV manufacturer. So you tell me we're in a recession, that people are laid off, we've got record unemployment, yet RV sales are through the roof, right? If you want to buy a camper right now, you're basically on a waiting list. So it's been amazing to see the difference in returns. So, let's step back a little bit. Like, let's go back a year and live in this dream world of no COVID. Markets are at record highs. Economic growth is still positive, but slowing. So signs are starting to point towards, you know what, as an investor, I'm going to get a little bit more conservative in my portfolio. I'm not necessarily going to dial back on my equity exposure, but I'm going to own stocks in industries that are traditionally, right, more blue chip, a little bit more stable, kind of bellwether, right? No matter what's going on from an economic standpoint, I want to own things like consumer staples, right? I got to buy soap. I got to buy laundry detergent. I got to buy basic household staples, no matter what's going on with my job, with my life, with my children's education. Things like utilities, right? No matter what, I'm going to pay DTE in consumers because I want to make sure my lights work. And this time of year, I still have hot water. In January, I want to make sure the heat works. And things like industrials or financials, right? The banking industry, the life insurance industry, manufacturing, things like that. So those more conservative sectors in a pandemic, in a recession, in a period of extreme uncertainty are some of the worst performing sectors so far this year. What's led the way has been consumer discretionary, information technology, and to a lesser degree, communication services. But remember that one of the largest stocks in that communication services category is actually Facebook. So arguably a technology name. So I lay that out because that provides an interesting backdrop. Like we've had from the S&P standpoint, it's like nothing's happened so far this year, even though we had a greater than 30% decline and a greater than 30% recovery. But essentially, if you were out of some of these tech stocks and consumer discretionary, you lagged a bit from a performance standpoint. So let's go from a growth standpoint. The overall return over the life of the Retiree Healthcare Trust is now north of 5%. So you've seen a nice recovery here. Ended the month of July at about $132.3 million. So nice growth so far here. Nice recovery off of those lows back in March. So from a performance standpoint, where do things sit? So for the month, we were up another 3.99%, right in line with the policy index. On a year-to-date basis, still recovering ground, down 1.2, but that's been one heck of a recovery from being down double digits through the February and March timeframe. So nice recovery out of the overall portfolio. Still lagging the policy index, really because of two managers with a value bias to their portfolio. So these are exposures we've had for a bit here, just with the belief that value was going to start to outperform growth. We've seen that shift from time to time, but not to the same degree or not to the degree that we would hope. But all in all, starting to see a nice recovery here. Ancora Thalen, for example, was right in line for the quarter, for the month. Sizer, we saw a nice recovery up until the last couple days of the month, but still up 4.5% for the month. So still seeing some nice growth out of that portfolio. One of the bright spots from an outperformance standpoint versus benchmark has been the international portfolio. Both First Eagle and the Vontable, which are our developed international equity managers, are both, for example, doing really well on a year-to-date basis, Vontable's benefiting from the fact that they have more of a growth bias in their portfolio. First Eagle, because they hold more cash and more gold and a little bit more defensive in their positioning. And then the Transamerica emerging markets portfolio has actually turned really well. This quarter, emerging markets is really the best performing part of the market. So you're seeing a tremendous recovery there. From a fixed income standpoint, it continues to be positive news. Rates keep grinding lower and lower. That's great for borrowers. That isn't necessarily great for banks and lending institutions. Isn't the best news for investors on a go-forward basis as we look at reinvesting at sub 1% interest rates. New addition back in June, really a tactical call and saying we think high yield is undervalued here. So shift out of Baird, out of that high quality portfolio and into Loomis. For example, that Loomis high yield portfolio was up 4.8% for the month versus Baird that was only up 1% for the month. So that tactical shift and adding that exposure based on valuations has been a very, very positive experience. Franklin Templeton continues to be positioned really defensively. Remember, this is a global fixed income portfolio that actually has very, very little U.S. interest rate exposure, very little U.S. fixed income exposure. So a lot from an emerging market standpoint, and they will go through pretty wide swings of performance. Final piece, real estate. This is the first quarter. If you look at this quarter figure, this would bake in the second quarter numbers. We're going to have zeros here for July because this price is on a quarterly basis. When you look back at the second quarter of 2020, it was the first time we had seen a negative return out of commercial real estate since 2008. So it had been a 10, almost 11-year run since we'd seen any type of pullback, any type of decline. And I don't think that comes as a big surprise for anyone looking at how people are considering retail and office space and the general slowdown you're seeing in terms of leasing activity. But PRISA continues to be a good performer in the long run, and we actually think is pretty well positioned. So from an asset allocation standpoint, as we round things out, we're pretty close to targets. There are no significant deviations one way or another. You'll see, for example, we've got a 47.5% target to domestic equity, and we're at 49%. So there are, any of the deviations versus target are 1 to 2%. We aren't 5% overweight something or 5% underweight. In an environment like this, we're going to stick to those long-term target allocations, just given the degree of uncertainty that exists in the world. So all in all, positive news across the board. That's really it from a coverage standpoint. I wanted to make sure we spent some time on the front end talking a little bit about that GDP number, so you had some kind of context around how that's calculated and why there shouldn't be as much panic as there is around that 33% figure. But other than that, we think the portfolio is doing quite well. So that's the extent of prepared comments. Happy to answer any questions that there may be.
Sounds good to me. Thank you, Brian. Does anyone have any questions for Brian? I'm going to go ahead and make a motion to receive and file the information that Brian provided. Is there a second? We've got a second from Kyle. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
Motion passes. Thank you. Brings us to legal. I'm going to turn it over to Tom.
Thank you. My recommendation would be is to receive and file the two reports as presented.
All right, thank you. And again, that's the same as last meeting. It's regarding the executive orders for
Correct.
for remote public meetings and electronic signatures. I will go ahead and make a motion to receive and file. I've got a second by Brett. All in favor? I'm a yes. Kyle?
Yes.
Paul?
Yes.
Brett?
Yes.
Motion passes. Julie, did you have anything under other?
No, thank you.
Okay. The date of the next meeting has been set for Thursday, September 10th at approximately 8:30 a.m. I will go ahead and make a motion to adjourn. Is there a second? Got a second by Brett. All in favor? I'm a yes. Kyle?
Yes. Did you say we're 8:30 next meeting or 8?
8:30 is the time for the retiree healthcare
Oh, right. Okay.
meeting. Kyle was a yes. I was a yes. Paul?
Yes.
Brett?
Yes.
Motion to adjourn passes. Meeting adjourned at 8:49 a.m. Thank you, everyone.
Thank
You got
you.
All right, thank you.
Thanks all.
Have a
Bye.
good one.